This year has seen a spectacular rise in market rates, and it's only a few months ago that we were excited when the 10-year Treasury yield hit 2%. Well, it's now pretty close to 3%, and the question now is what happens next? The simple answer is rates should go higher because, after all, isn't inflation at 8.5%? But it's not as simple as that, because the 10-year rate is more concerned with long-run inflation expectations. The 10-year inflation expectation is currently around 3%, which is too high. And the risk going forward is that it continues to rise. And let's suppose it went up to 3.5% or higher. That's the type of backdrop that would correlate with the 10-year Treasury yield heading for 4%. One of the jobs of the Federal Reserve here is to prevent that from happening, or more specifically, to prevent inflation expectations from getting out of control. Given what we know, in all probability, inflation expectations will likely overshoot, taking the 10-year Treasury yield up to around 3.25. Could it go to 3.5? It could, but if it did, it most likely means the Federal Reserve is losing the battle against inflation expectations. Either way, we're on turning point watch here. The thing is, turning points are notoriously difficult to pinpoint. We would say, however, that when we do get to that turning point, in all probability, inflation expectations will have peaked and will have begun to subside, which means the Fed finally has control of the situation.